David Neuhauser is back here on the program with us to take us into the closing bell. He's managing director at Livermore Partners. David, good to have you here on an exciting day.
Yeah, thank you for having me, Oliver.
So I'm looking at one of your notes, and you describe it as a Dr. Jekyll and Mr. Hyde market. And yesterday, I was calling it the two-faced market. So maybe we're on the same page. Walk me through what you mean.
Yeah, so I mean, I think you've seen a pretty strong move off the bottom of March, since March, as you know. But you know, it looks like we've had a great uptrend since then. But anytime a market's move this fast, this swiftly, you know, it's obviously due to cool off. And the fundamentals never really supported the type of ferocious rally we've had. So it's not surprising, but to be honest, it's been very a humble experience this year, the way the markets have trended.
Now, does that mean that you were too short as this thing was going up? Walk me through how you've been navigating this, David.
Yeah, no. So it's been tough. Simply because, look, we started the year at a pretty high valuation, and then we got to a higher valuation to start the year, and then of course, as COVID-19 took hold, we saw a massive bloodletting to hit the market, and then since then we've gone right back up. So fundamentally, nothing has really changed from an economic standpoint from what we've seen with COVID-19. So we're going to have a big drawdown in GDP growth. We're going to have massive unemployment for obviously the next several years. And we've countered that with stimulus, but it still doesn't equate to higher earnings multiples and higher multiple expansion, which the market was trying to bring forward.
David, doesn't some of this just really boil down to whether one has a negative view of the economy prior to the virus? Because if we go with the hypothetical here that has been taking hold the last month, which has been reopening, eventual continuation of activity in life mostly as it was, if that happens to the fullest extent at some point in the future, then wouldn't that mean that markets could continue their trajectory higher? Do you have to have a more structural view that there are problems within the system to be a deep bear here?
Yeah, look, you could be a deep bear. I think there have been a number of deep bears for a long time. I'm neither. I mean, obviously, we're value investors and special situation investors. So that's all I truly care about, though you have to pay attention to the macro. So, I would argue the markets have been overvalued, but policy has kept them overvalued. So just when you saw some fundamentals take hold in terms of the negative, in terms of unemployment, recession due to the pandemic, you would think that would be systemic and it would have a massive blowdown to both the economy and the stock market. But instead, you've seen that the stock market has taken the cue from policy, and thus the companies that have regained, I would say, their valuation or even gone a lot further on their valuation have been the money-losing, high-growth, high-tech areas of the market, which to me is extremely troublesome. The issue is it's been painful to try to short those stocks because without earnings and with the view of there's growth, people tend to put valuations that are a bit obscene. So we've been trying to stay away from those and focusing on our core, which is value, special sit. As you know, I like gold, I like oil, and I like material names. But I like those very specific companies where we feel there's tremendous value on a recovery.
I know you have that focus in the special situations on the miners and some of the energy companies as well. Are those right now demonstrating that they have some disconnect from the broader macro moves, or can one look at them in a group and just kind of say generally with these macro trends that we need to have big improvement for them to work? I mean, oil's down 10% today.
Yeah, so the way we're looking at Livermore is, again, focusing on very specific situations. So I think I've touched on before, we own the oil companies we own, things like Vista Oil and Gas, which I made a presentation on a week ago, or Jadestone Energy. I mean, Jadestone has zero debt and is free cash flow even in the mid-30s for Brent, where Vista, it has the decree where they're tied to Brent in Argentina, and Argentina put in a $45 decree, so they're still getting $45 a barrel for the oil for the rest of the year. Both these companies, I'll say, are run by excellent management teams, have excellent assets. So you're buying them on a recovery view, but you're also buying them on a value, thinking that there's limited downside and there's a level in which they should be bought. But again, you have to be able to look out long enough to say, look, on a recovery, what does this company look like and what could they be valued at? And for me, I say both those companies could be valued much higher.
Back to the gold situation here, too. Our CPI prints, as this thing has been going on, are much more on the side of deflationary than inflationary. But as we've discussed here on the program, too, I sympathize with the case that if a few things change and demand does pick up in areas like apparel, energy and other things, then suddenly the conversation for inflation might be very different. What are you looking for, David, to see if inflation really is taking root? And kind of a follow-up there, but part of it is enough inflation to really drive gold higher.
Yeah, so I think in the short run, given all the macro, obviously with shutdown and companies and travel and things like that, we're in a deflationary environment for sure. But I think as you move forward and you see supply chain issues, as you see more localized production happening, costs are going to go up. You're already starting to see it in things like food, or if you're trying to buy different paper products at the store. So there's definitely inflation forming in the economy, and that'll bleed through to eventually to the producer. So even going back to what I said with oil or gold or other miners or even other material companies, what we're looking for is those companies that can make it through the storm, and that as things improve, there's going to be tightness of supply. I mean, it goes back to like we talked about with gold and even with oil. I mean, I think you've seen a lack of investment and capital investment for the past number of years in both those sectors. Ultimately, that'll lead to deficits, similar with copper. So even just a slight uptick in demand, which I expect to occur over the next 24 to 36 months, especially with current policy by the Fed, you could see some of these companies start to print cash and their valuations spike.
Yeah. David, the last one here, back to the NASDAQ stuff. I know in the past you've gone after companies that were very high beta, speculative trades like Tesla and such. Is there anything stock-wise that interests you from the short side right now?
That's a difficult trade, and it goes back to what I said, is that when you have policy, essentially printing money and giving money away, you have a lot of cash still on the sidelines, and what they're finding comfort in is technology and high growth, especially in those money-losing companies. So I think it's a painful trade to be short. I think if you're short, you could make money, but you're going to have to pick your spots, and you're going to have to be able to sit in and take some pain. I think once, we knew the Fed was there buying junk bonds and things like that, which to me ultimately can create moral hazard. I think the key is you got to stay away from those speculative short bets. What you could focus on instead, like I said, is your default option is still to buy things like gold and bonds, obviously, especially if you think that the yield curve is going to continue to flatten and essentially invert at some point.
Yeah, okay. David, good to catch up. Pleasure having you back here on the show. And as we see, Amazon, Netflix, a lot of those companies doing better than the rest of the market, which is taking a bludgeoning today. David Neuhauser joining us, the managing director at Livermore Partners.